and welcome to the LA Venture Podcast. This is Minnie Ingersoll, host of the podcast and partner at 10110. 10110 is a seed stage fund here in LA. All opinions expressed on this show by me and my guests are solely our own. Bruce Hallett is a partner and one of the founders of Miramar Digital Ventures. Miramar is a seed and early stage venture fund focused on the future of data. Miramar has about 25 companies in their portfolio, and about 2/3 of those are Southern California-based companies, many in LA, but Miramar itself is based in Orange County. Bruce has been doing venture for a couple decades, and I am excited for what I'm going to learn from him today. Thanks for being on the show.
Oh, it's my pleasure, Minnie.
Great. Well, I guess the first question is, did I get the introduction right? And can you share a little bit more about Miramar?
Yeah, I'd be glad to. We have a history kind of through, two different series of venture funds. And I go back, we can talk about this later because that's part of our connectivity with 10110 and Gil and Eitan Elbaz, is that back in the late 90s when I was a lawyer at Brobeck, I was their counsel. I was also running a venture investment fund with some other partners at Brobeck. So we were investors in Applied Semantics and a number of other companies. So that's kind of how I got started and really got the bug for investing. And then one of my other clients was Broadcom. I had taken them public, and they almost, wore me out doing lots of M&A in 1999, 2000 timeframe. And then this decade partnered up with Sherman Atkinson, who had come out of his company originally acquired by Buy.com, one of the early e-commerce companies based here in Orange County. Then he went to LA to help with the turnaround at Intermix Media, which owned MySpace, successfully did that and sold that to News Corp.
So you went from helping companies like Applied Semantics to kind of doing corporate venture in a sense at Broadcom, right?
Right.
And then and then when did Miramar come into existence?
Well, Miramar Digital Ventures, which Sherman and I formed in kind of 2014 timeframe, we launched, and that was about a $25 million fund, and we were focused on data, mobile data, IoT, and then just earlier this year we closed on our second fund, Miramar Digital Ventures II, which is a good deal larger, thankfully, and we hope to, by the time we're done, have about $100 million under management in the second fund.
Great.
And so that enables us to invest, not just at the seed stage and Series A, but to kind of keep up with some of the companies that have been successful in the portfolio, including crossover investments in companies where our first investments were in Miramar Digital 1, but we've kind of reached our concentration limits, which you understand that means it's usually about 10% of your fund can go into a single company. And so in this case, with the larger fund, we're able to continue into some of the same companies from Fund 1 and try to maintain, some semblance of our original percentage in those companies.
So so with this larger fund, I imagine will you be leading seed rounds? Is that kind of your sweet spot?
As far as leading, we're happy to co-lead. We're happy to go in on convertible notes. We can do safes if we have to. We can talk a little bit about that later. We kind of prefer convertible notes, but we're really looking for great teams who have high proficiency in AI and data science and are using it to transform existing industries.
Do you have certain trends that you're following or on companies that are a good fit for you?
Well, first of all, there's no such thing for us as too early. We are, very happy to, kind of go in, even alongside angels and start out putting a couple 100,000 in, maybe 200 to 500 is our sweet spot as far as the point of entry. And then, we have the capability of putting, millions in subsequent rounds. So we love that.
And so how do entrepreneurs think about when they, why go to Miramar versus someone else?
I would say we're very quick. We're very certain about what we do and don't do. So, there's not a lot of mission creep with us where we go, oh, we might do that. Let us spend some time and due diligence. And the nice thing about a bigger fund is that we can expand the team, and, we're looking to, add some team members this time around. And one of the EIRs we've added is Stuart McClure, who is the founder of Cylance, the cybersecurity company here in Orange County that was acquired by BlackBerry last year.
How do you think venture has changed and will change?
Well, that's a great question. It has changed a lot. I mean, the big funds, especially in the early 90s, when I started working with, Brentwood, Redpoint, Enterprise, Crosspoint, all those funds were sort of in the, 50 to, maybe $100 million size. And that was pretty typical. There were a few funds in Silicon Valley that were bigger, but even the big funds in Silicon Valley might have been more like, 200 million. And then, of course, the other factor is these just mega funds. I mean, these funds that are $1 billion plus and come in, mid to late stage.
But a lot of those funds are going earlier. It seems like it. I don't know if Andreessen or who's the best example, but a lot of them are now running their seed programs or something. And so I wonder, what does that mean for those of us who are in the sub $100 million category?
I think it means we better be there early, and we better be there with conviction. And, we also better be prepared that we're going to have, co-investors, maybe from, Series Seed or Series A, who are mega funds and have that kind of tension or dynamic between, we may, as smaller funds, want to see more, capital efficiency and hitting milestones and proof points. And the bigger funds, if they're starting to commit serious dollars, part of their model is to put as much money to work for, serious ownership positions as possible. A lot of times they're not too sensitive on valuation. But sometimes, I mean, I've seen this, you probably have too, where they can kind of swamp a company with, too much money and too high expectations.
Yeah. No, I think
have you experienced that too?
Oh yeah, unfortunately, a little close to home for sure. Before doing VC, I was a founder, and we took a lot of money. So I think, from the venture point of view, though, one question is, and you're a former lawyer who's worked on deal structure. Are there things you can do on the deal structure to avoid getting smushed by the larger funds that can pour money in later?
Well, there's ultimately the answer is probably no, but but there are, on the margin, there are ways maybe we can protect ourselves or steer things in a, what we think is a more prudent direction. One of the ways, there was kind of a mindset of early stage investors that there was a lot of times, kind of an inclination to, in addition to preferences on the preferred stock, having a participating preferred. And so what that means, as is that the preference just says, hey, you get your money back, if there's a if there's a liquidity event before the common does. But the participation says you get your money back, and then it's like you convert to common and you participate with the common. So in that situation, the investors with the participation get paid at least twice on their early investment. It's kind of tantamount to at least a 2x preference instead of a 1x preference, and sometimes can be much more. So what has happened is that as these rounds have gotten larger, like in the 90s, a company did an IPO or an acquisition at a $200 to $300 million market cap. Mm-hmm. Well, now that's just like a Series B or Series C for most companies. And if they hit that milestone, they're on their way to being a unicorn. Mm-hmm. But the longer you can defer, and maybe it's perpetually, you can defer having participation rights on the preferred stock, the better, because as an early investor, you're later going to get swamped by the big investors if the company's successful. And if those big investors just have the same simple preference that you do, like a 1x preference, it's going to be a lot better for us and the founders not to have a huge stack of preferences that get paid, and then participation again when the company goes public or gets sold.
So you've been doing this longer than I have, and you have more background here. So I just legitimately, how often do you see the participating preferred, and when does it come in? I don't feel like I would see it much at the seed stage right now. And I think liquidation multiples are usually come in later as well. But is that true? And how common is it?
I think it is. I think it is true. And what I'm saying, though, is that in the 90s and even early 2000s, VCs, from the get-go, the Series Seed or Series A investors would, want the right. preference and the participation. At this point, I think we've all figured it out as early stage investors, and the status quo is not to have a participation and just a 1x preference, which means that if the company exits over that 1x, everybody's going to flip over and convert to common anyway.
Right. And everyone converts to common. I'm just learning this. You convert to common when you IPO and when you SPAC, it turns out, I believe. This is what I'm going through.
Yes. Yeah. That we haven't had anybody that's SPAC'd yet, but that is my understanding.
And what did you say at the beginning? I think you said you prefer notes over safes. Did you say that?
I did. Yeah. I mean, safes were kind of all the rage when they got, launched out of D Combinator, in 2013 or so. The idea was that they were going to just sort of streamline the whole process by, not having an interest rate, not being considered debt, going on the, cap table instead of, showing up as, debt on the balance sheet. And I think what's happened over time is that, from an investor standpoint, a lot of us have come back around and have a preference for convertible notes. It's not that we won't do a safe. I mean, particularly if, we're the last investor in and everybody else did the safe and the terms are okay. I mean, one of the other things that got popular, 5 or 6 years ago was not having, any interest rate or discount rate or cap on safes. And so, I mean, from an investor standpoint, it's like, well, why not just wait until the company does a round of financing and get the same pricing? You're taking a lot less risk. And the founders have to realize that for the risk your earliest investors take, there's got to be some benefit. It shouldn't be overreaching, but to have a 15 or 20% discount to the next round price is a good thing. Having some type of cap. And then the other thing on a convertible note that we like is, even if it's a notional interest rate, like 5%, and we always want to convert that into the final, whatever the round is. It kind of gives you a little bump, a little benefit if it takes a while. So all those things contribute to our preference for a note versus safe. And then the other thing is that, and don't hold me to this because I'm not a tax lawyer or anything like that, but I believe there's a benefit if something, goes off the rails, if the company doesn't work out, if it fails, and you have a convertible note, you can deduct that as business debt versus a safe. I think it's a long-term capital loss.
Why, this sounds very basic, why do entrepreneurs still get in trouble with this? In the sense of, I sort of thought, and maybe you can tell me, who are the best law firms? Doesn't everyone sort of work with like a Wilson Sonsini or a Gunderson or a Fenwick, or maybe I have the names wrong, but I'm curious, who do you recommend entrepreneurs to work with, and shouldn't that just cover them?
I think for the most part, and all those firms should be on the short list. I mean, Cooley, K&L Gates. There's a lot of other ones too that, and even smaller firms where there's kind of spin-offs from the big firms, and they're very efficient. But yeah, it's usually not a law firm thing. It's usually something where maybe the law firm isn't even involved, and the founders got a safe off the internet, and they just want to use that. And sometimes you're kind of stuck with it, because if they've raised too much money on the safe, you're not going to change it. So you just have to make the decision, well, will I take the suboptimal, document and go with it and be part of this round? Or, do we need to reconsider the whole thing? And of course, if we reconsider it, and of course the company wants or would need to agree with this, we'd usually just sort of change the terms for everybody, who's signed the safe at the beginning. And, we want to put something in place that is a little bit more formal and investor friendly.
Yeah. But, it seems like where founders get in trouble also is the layered notes right now as well, which isn't a lawyer thing again.
Layered notes from the standpoint of they'll do one round of notes for $2 or $3 million worth, and then they'll do another set that's converts into the next round too.
I was thinking, I haven't seen as much as you, but sort of we have a note with a 3 million cap, and then a note with a 5 million cap, and a note with a 7 million cap, and then the round gets priced at 11, and the person with the 3 million, the founder doesn't realize how much ownership they've given away.
Oh yeah, yeah, and sometimes that's not only kind of a showstopper from the founder standpoint, but if you're a later investor, it is too. Or if you're the person leading the round and you find out, I'm leading a round at $12 million, but there's a person with a $3 million cap. I want the prior investors to be treated fairly for their risk, but I'm really betting on the founders, and the founders aren't going to end up with enough of the company then. Mm-hmm. And this is just the Series C or A, so God knows what's going to happen later. Right. Yeah, so you don't want to see that happen.
And then how do you think about your own ownership getting diluted?
That's a great question. And it's probably going to be, end of the 10-year term before those deals see liquidity. But that's also one of the reasons where in, modeling this next fund, we're figuring that somewhere between 40 and 50% of the capital of this fund is going to get invested in later stage opportunities, most of which we developed in the first fund, and are now in, Series B's, C's, and D's. And so those are closer to liquidity. And we may even have some that are, within 18 months or 2 years of liquidity, but, they're not going to be the, 15 to 100x that we're hoping for in the winners at the seed stage. But, by, getting some quick, 5x's from the later stage deals that are de-risked and closer to liquidity, it'll kind of keep the flywheel going as far as capital back to our investors, and keeps everybody happy.
Yeah. And if you weren't reinvesting into a round, like, how do you, either for your fund or for your founders, tell them to think about the dilution they should expect in a Series A, Series B, and later rounds?
Yeah, I mean, it does hopefully step down as the valuation goes up, but there's also a tendency to raise bigger rounds.
Right.
So it's the sort of thing where, if a company's at a, $2 billion valuation and they decide, they're raising 200 million, then it's, around a 10% dilution, but, it can be considerably more if they raise more money. And there's a lot of pressure to do that. And so again, it's at that stage where it's not venture debt, but a company at that point where they've got the revenues to drive that kind of valuation. I think they ought to be looking at, debt facilities and, working with sophisticated lenders to, use debt for acquisitions and, other strategic initiatives versus necessarily just kind of, adding to big rounds of equity.
Yeah. So before I get into the personal question section of this interview, tell me, are there other things about Miramar or other thoughts you have for entrepreneurs that we should cover?
I would just say that we're big fans of entrepreneurs. I mean, I think, and I would say this is true of, most Southern California VCs, is that we see ourselves, as supporting entrepreneurs, not telling them what to do. I've noticed that, in some parts of the country, there seems to be more of a mindset of, we're, this fund, we're masters of the universe. So when you get us, you get, we'll give you instructions on, how to run your company. And I mean, some of them do real well with that. But I think we see ourselves, and we love to co-invest with people who kind of see it as, look, it's a journey we're all taking together.
Great. I really appreciate that. And first personal question is there a wetsuit hanging on the door behind you?
There is.
Awesome.
And it's not mine, which probably makes it even more interesting. Sherman, who now, spends most of his time in Park City, is a big surfer when he's, not skiing or doing VC. So that's Sherman's wetsuit, and this is his surfboard.
Nice.
Okay. So it's basically just storing it in the office here.
Do you have any advice that you really like, either giving or advice you've received?
Oh boy, I guess it's just kind of fundamentally treat everyone with respect. Have appreciation for the job that everybody is doing, and I think people always show their best in that situation. So I don't know. That's not a very articulate way of saying it, but that's what I believe.
I believe that too, but it's good to be reminded of these things. My mother says repetition doesn't ruin the prayer. I like that. Well, thank you so much. I think that's all I've got for you today. And I really appreciate you coming on the LA Venture podcast.
Oh, it's my pleasure.